Hello everybody and welcome to this video where we will be focusing on some of the largest financial service corporations that focuses on electronic fund transfers throughout the world, most commonly through their own branded credit cards, debit cards and prepaid cards. However, there's also some who focus solely on digital transfer of funds. We have today selected the 5 following companies for you. The first one is Visa, stock ticker V. Second one is Mastercard, stock ticker MA. Third one is American Express, stock ticker AXP. Fourth one is Discover Financial Services, stock ticker DFS. And finally, PayPal, stock ticker PYPL. So first of all, we obviously want to understand how these stocks have been performing in the recent periods and whether they are in what we consider an uptrend or a downtrend. So if we take a look here, we can see that Visa, Mastercard and PayPal all have been doing fairly well for the most recent periods, especially PayPal, which has gained an impressive 74.22%. On the other hand, American Express have lost 13.46% and Direct Financial Services lost 30.85%, which could be a sign of them being in a downtrend. However, if we take a look at the last 6 months, we can see that those two stocks have also gained, so that gives us a bit of a comfort on the trend side. If we then move next to the income part, we want to have a look whether these companies are actually earning any money or not. And if we look across the board, they are all greens, which means that they are earning money, which is good. If we take a look at the margins and especially the net profit margin, which is one of the most important ones for me, we can see that Visa and Mastercard are distancing the others by miles. Visa has gained 51.27% and Mastercard has gained 44.9%, which is really impressive, especially compared to the others, as you can see here. Then we take a look at the Beanish M-score, which is a mathematical model that determines whether a company has manipulated its profits. And what we want this score is to be less than minus 2.22. So here there's quite of a red flag for Visa, which has a plus 1.97%, while as the other ones are in the safe zone. Then if we take a look at the Sloan ratio, this is to identify if a substantial part of the earnings are non-cash accruals, and we are obviously not interested in this. And we want therefore this to be between minus 10% to 10%. And again, if we look across the board here, all of them are in the safe zone, which is really good. Now we move into a new element of the video that has changed from the most recent ones. We have decided to change a bit because we felt that it was important to have a more high-level comparison between the companies on some of the most crucial elements that we're walking through in the video. So first of all, we looked at whether the stocks were in a trend, and what we could see that all of them, at least for the last 6 months, are in an uptrend. Then we went to the income part and specifically the net income, and what we could see that all of them were positive, which was really good. Then we go into the ranking where each company will get 1, 2, 3, 4, 5, 1 being the best, 5 the worst. So if we go down here, look at the net profit margin, we can see that Visa had the best score, followed by Mastercard, PayPal, American Express and Discover. So this is just to give a bit of an easier flavor of who is actually scoring the best. It does not show the degree of difference between the different scorings. If we then move into the next section, which is return metrics, we here want to have a look at how high returns and cash flow margins is being generated by the companies. And if we first take a look at the earnings yield, which is benchmarked against the S&P 500 average, we can surprisingly see that Visa, Mastercard, and PayPal are actually doing the worst. American Express is doing well with 4.48%, and Direct Financial Services is doing very well with 5.4%. However, the picture turns a bit if we go to the return on invested capital and cash return on invested capital, where Mastercard by far are outcompeting all the others. The only one who is remotely close is Visa with the numbers as illustrated here. Lastly, if we take a look at the levered free cash flow margin, which illustrates how much money is left or percentage is left overall after all expenditures are paid, we can see that Visa and Mastercard are doing really well, closely followed by Direct Financial Services and PayPal, while as American Express are scoring really poorly again. Then we move into the balance sheet, which is to assess how financially strong these companies are. The current ratio is looking really good across the board here, while as on the cash ratio side, it's looking a bit more dire for PayPal, American Express, and Direct Financial Services. The two most important metrics for me is the total assets versus total liabilities, and I in general would like this to be above 1.5. We can see that it's only Visa who meets this requirement. If we then go to the debt equity ratio, again we can see that Visa, closely followed by PayPal, are doing the best, while as there are some small red flags here on American Express and DFS, which is a bit high for my taste. If we take a look at the Element Set score, it's a credit test that assesses the likelihood of bankruptcy, and we can see there's no reason to be worried about that for Visa, Mastercard, and PayPal. Again, small warning flags for American Express and Direct Financial Services. If we take a look at the Piotrowski score, it's another one that assesses the strength of the company's financial position. Here, all companies are scoring fairly okay, and surprisingly enough, Direct Financial Services are actually the one doing the best. So if we go back to the status overview, we can see that for the return metrics, and more specifically return on invested capital, Mastercard was doing the best, followed by Visa, PayPal, American Express, and Discover Financial Services. On the levered free cash flow margin, we could see that Visa was the best, followed by Mastercard, Discover Financial Services, PayPal, and American Express. On the balance sheet, on the total ratio, again, similar trend here with the best companies being Visa, Mastercard, and PayPal. And the same again with the debt equity ratio. So we are seeing kind of a pattern of the first part of the evaluation. Next, we want to have a look at how much shareholder value is being returned to shareholders either through dividends and or buybacks. So if we first look at the dividend yield, we can see that Visa, Mastercard, and PayPal are not paying anything exciting. American Express has a small one at 1.68%, while as Discover Financial Services are doing quite well with 3.19%. Buyback yield, which has become more important in recent years for a lot of companies, we benchmark with the S&P 500 Q1 data, and what we can see here is compared to this, all companies are doing above. American Express and Discover Financial Services again doing the best with 8.23% and very impressive 23.69% for Discover Financial Services. However, what we want to understand is this sustainable going forward? So the modified payout ratio tells us the proportion of the earnings are paid to shareholders in the form of dividends and buyback, meaning that if the modified payout ratio is above 100, this is a little bit of a worrying sign because it shows that this is unsustainable if it continues in the long run. So looking at Visa and Mastercard, they are all right. PayPal, huge doubt as to whether they can continue their buyback in the future. American Express and Discover Financial Services are shown as red here. However, I would say considering the high buyback yield they are paying to their shareholders, even if they cut back on this a bit, they will still provide a very, very generous total shareholder yield. So again, I wouldn't be too scared of that as of today. If we then move to the earnings per share growth, we want to understand, will these companies continue to grow in the future? Because we are obviously interested in investing in growth companies. So looking at the EPS growth forecast for the next 5 years, it's a very important metric. We can see that all the companies are expected to grow in the future. PayPal is expected to do the best with 23.37% on an annual compound growth, and Discover Financial Services are doing the worst with 0.7%. Then we also take a look at the revenue growth past for the 5 years. Again, you cannot use the past to predict the future. However, it tells us a bit about how well the companies have managed the last 5 years. And as we can see, Visa, Mastercard, and PayPal has by a long margin outperformed both American Express and Discover Financial Services. If we go back to the overview, we will see that for the total shareholder yield, Discover Financial Services are doing the best, followed by American Express, Visa, Mastercard, and PayPal. Again, I do understand that the modified payout ratio is above 100% for these two companies, but given the fact that they can still cut it by quite a bit and still provide a very good total shareholder yield, I feel that they are providing the best value on this parameter. Then we go to the earnings growth and the EPS growth forecast for the 5 years. PayPal, followed by Mastercard, American Express, and Visa are doing the best. And on the revenue growth forecast for the past 5 years, here again, PayPal were doing the best, followed by Visa and Mastercard. Now we move into the last section, which is basically to understand whether the companies are currently under or overvalued. One way to look at that is the PEG ratio, which basically shows that if a company has a PEG ratio below 1, it will be considered undervalued. If it has a PEG ratio above 1, it is considered overvalued. So if we look across the board here, we can see that all companies currently are considered overvalued by quite a margin. If we move further to the next section, which is my own estimated intrinsic value of these companies, which is based on a lot of different assumptions and numbers, we're coming to a similar conclusion where all companies are considered overvalued. PayPal only were 2.61%, while as Visa is with 16.81%. If we take a look at the beta ratio, this just shows the volatility in relation to the overall market. If the beta ratio is below 1, this means that the stock moves less than the general market. If it's above 1, it means that it moves more than the overall market. So we can see here that all these stocks, except Discover Financial Services, are quite stable and quite closely follow the market. Next, another value indicator will be to look at the book value per share. And again, all companies are here also considered overvalued. We look at the relative strength index for the last 14 days. If this is below 30, they're considered oversold. If it's above 70, it is considered overbought. We can see here that all companies are in the middle of the ranges for these. So again, they are not necessarily undervalued, but they are neither necessarily overvalued. Last, it's always interesting to look at what the analysts are saying, even though they may have their own agenda. I still somehow like to stick a bit about the consensus around these analysts because I think it has an impact on which way the stocks are going. And again, looking across the board, there's a bit of upside to most of the companies here, all of them actually. The highest will be in Discover Financial Services, which has 10.55% upside as of today, while as the others are between 0 to 5%. What is important to note is that this is the consensus price target, which is it's kind of like the middle ground of all the estimates that they're providing. So some analysts will obviously have a lower price target than this, while as others will have a higher price target. So looking overall on the intrinsic value of these companies, it would appear that all of them are to be considered overvalued. However, it is important to note that there's a lot of uncertainty around these estimates, and I would stress that if you looked in the initial part of the presentation, all of these companies are a little bit below their, or more for some, of the 52-week high. So again, it illustrates that these companies have had a higher share price within the last 52 weeks. So now we have been through all the information and comparison of the different companies, and based on that, we have selected a top pick for today. The top pick is based on the following reason. It has a high net profit margin of 51.27%. It has a high levered free cash flow margin of 50.43%. Very low debt equity ratio of 0.5. Room for increase in shareholder yield. Expectation of continued future growth. We have selected Visa. Again, we do understand that there is a bit of uncertainty around the B score, which is a red flag, but given all the numbers that we are seeing, we still believe that Visa is the best pick for the long term. We would though say that PayPal and Mastercard are two other good options, and we do not believe that you will go wrong with any of these companies if you stick with them for the long term. This industry is going to see more growth in the future as people move to more cashless society and as people start buying more over the internet. This was all for today. We hope you liked the video. Please leave a comment below, subscribe for future content, and otherwise, please provide any comments or suggestions for improvement that you may have so we can provide better content for you in the future. For people who want access to the data and to have more additional bonus content, please check our Patreon page. You can see it in the description below. Thank you very much and have a very good day.